Welcome to the Trepp podcast, the show where commercial real estate meets data and insights. This is our week in review for the week ending January 30th, 2026. I'm Haley Keene with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Lonnie Hendry, Chief Product Officer, and Stephen Bushbaum, Head of Applied Research and Analytics. This week, the Federal Reserve held interest rates steady at its January meeting, reinforcing the message that the economy is still expanding, but not without pressure points underneath. The Fed said economic activity continues at a solid pace, job gains have slowed, the unemployment rate is showing signs of stabilization, and inflation remains somewhat elevated. That mix keeps policymakers firmly in a wait-and-see mode. Markets are now focused less on the timing of the first rate cut and more on how long this policy stance holds, especially as political noise around the Fed grows louder, including renewed debate around central bank independence and speculation about who could eventually succeed Chair Jerome Powell. On the CRE side, we're checking back in on the multifamily market with our team on the ground this week at the National Multi-Housing Council Conference, getting a real-time pulse on lender sentiment, underwriting discipline, and how investors are thinking about supply, demand, and distress in 2026. So, Stephen, after this week's Fed decision and what we're hearing from both the macro data and the commercial real estate markets, what's standing out to you right now?
What's standing out to me right now is that we're in this awkward, steady policy shifting risks phase. On the Fed side, holding rates steady was not the surprise. It's the composition of the message. You've got an economy that's still growing, but the labor market is clearly cooling in the margin, and inflation is still sticky enough that the Fed can't declare victory. So the conversation, as you mentioned, is moving from when do we get the first rate cut in 2026 to how long does restrictive policy stay in place? And for CRE, that's a big deal because it keeps the cost of carry elevated and it keeps the volatility premium in the market, which shows up as wider spreads, tougher proceeds, and a higher hurdle rate for equity. But as we've discussed many times, and Lonnie, you've stressed this very, very well, we've largely calibrated to where rates stand currently, and we seem primed to do really well in 2026 despite all of this mess. Then, when you overlay the political noise and the central bank independence chatter, it's not that any of this changes underwriting models overnight, but it does add to headline risk, and headline risk tends to mean lenders and buyers demand more cushion. On multifamily specifically, what we're hearing at the NMHC lines up with what we've been watching. It's still a selectively open lending market. The best sponsors and the best bases can get done, but underwriting discipline is real. Higher debt yield expectations, tighter debt service coverage, more reserves, less leverage, a more realistic or more conservative rent growth forecast, and a lot more scrutiny on near-term lease-up and refinance plans. It's effectively, in some, disciplined underwriting. And the biggest divider right now is supply. Markets with heavy deliveries and rent concessions feel very different than places where supply is easing and demand is holding. So heading into 2026, I'm watching two things closely: where the supply wave is peaking versus rolling over, and how quickly capital markets confidence returns for refinancing, especially for floating rate transitional vintage. So that's the tension. Fundamentals are stabilizing in pockets, but the capital stack still wants more breathing room. Now, Lonnie, I'm curious to hear what your take is on all of this mess this week. Can we keep our heads down and just keep pushing through? Or should we maybe be keeping just one ear to the wall on some of this political nonsense?
Look, I think if you read between the lines with Powell, in fact, you might not even have to read between the lines. I think he was pretty direct in his quotes around the Fed independence here. And I think, he's been on record as saying, they cannot continue to fight this fight effectively. Like, they're going to do what they think the data suggests they should do. And his advice for the new chair that's going to be incoming in 2026 is to do the same, that you cannot bow to elected officials and the pressure that's placed upon you. I don't think, as you mentioned, them pausing on the rate cut for this meeting was not a surprise. I just think that we're in the lame duck situation. I've talked about this for the last several months. Is like 2026 is not going to be determined based on what Jerome Powell's Fed does. 2026 is going to be determined from a rate perspective based on what the incoming Fed chair is going to do. And while it's mid-year, there's going to be a lot of opportunity for them to really completely change the narrative here. So whether it's politically driven, motivated, whatever, or if someone comes in and actually continues to look at the data and toe the line, I think that remains to be seen. But I can assure you of one thing: if we don't see the type of transaction velocity and the type of activity that I think people are expecting, and mostly in the administration in the first part of 2026, I think they're setting themselves up for a really dynamic end of the year with a new Fed chair aggressively cutting rates, which will then create a whole different talk track for everybody. And some of these concerns that people have had around inflation and everything else become much more on the forefront. And people will be talking about what this means more broadly heading into 2027. So, I don't want to, just smooth over what happened today. And I don't want to, rush Powell out of office before his time. But at the same time, it doesn't feel like nothing, there's not much impact that he's going to have other than just continuing to try to, highlight the fact that, while he's been in office, he's towed the line and kept the independence of the Fed what it is. So not surprised by any of that. I think we'll continue to see him, especially with this investigation and everything that's going on now, continue to be a little bit more boisterous around, the independence component. Now, we talked about a couple weeks ago. Hopefully that just goes away because it just feels like a bogus deal to begin with. On NMHC and kind of the multifamily stuff, I know we're going to kind of dive into that, a little bit deeper later on in the show, but I'm kind of torn on this because it feels like, depending on who you're talking with, there's this selectively open or kind of cautiously available credit or whatever. But if you talk to other people, I mean, they're basically saying, 2026 is the year that they're coming back into the market like full tilt. And so I don't know if some of the selective discussion or talking points or whatever is just kind of a carryover from what we've had the last couple of years where, the folks that are making loans and the people that are on the front lines are just by nature going to be a little bit more cautious in their terminology and the way they frame where they're at. But if you're talking to the deal makers, I mean, like at CREFC and even post CREFC, I mean, in every meeting I've been in or, lunches I've gone to or whatever, overwhelming confidence of people saying that they're going to do X number more deals this year, or they're going to deploy X percent more capital this year into the CRE markets than they have the last couple of years. So, I think it'll be interesting just to see how this selective, tighter underwriting, more restrictive policy, actually marries up with these deal makers wanting to aggressively go back into markets. And it feels like, for every headline we've gotten around the Sun Belt and some of these markets being soft for multifamily, that's where you're hearing a lot of these investors saying they see the biggest upside and opportunity. And so it's almost like, I'm not going to go back to the tale of two markets like we've seen with the office market or this broad bifurcation, but there's definitely like a little push-pull given here in terms of just what is selective and what's wide open. What are markets that really are distressed, and are those the same markets that do provide the most upside and opportunity? The one part that I think that I really liked from your intro is, I definitely think you're going to see more scrutiny on lease up for these new construction projects. And I think you're going to see much more disciplined approach on year one, year two rent growth projections. I think you're going to see people being a lot more muted in their expectations around those two items in particular, notwithstanding the overall optimism around the sector.
Yeah, on the topic of the NMHC conference, this is always a big one because it really sets off the start of the year for the multifamily market. And a lot of people turn to LinkedIn and other social channels to share their takeaways and sentiment. I know we already caught a post, Stephen, from Brandon Roth that was actually breaking down some insights that he learned from a JV equity investor and what they're targeting. I think we should walk through this and why this was so interesting.
Yeah, I love how thorough this post was. I mean, this is beautiful. I love it. So first off, thank you, Brandon, for posting it. This is the kind of engagement out there that I love to read and chew on. So here's what he said they shared. They're looking to close 4 to 6 ground up multifamily or build to rent developments this year with equity check sizes 30 to 40 million. They're less focused on return on cost, more focused on underwriting to a 15+ plus% IRR over a 4 to 5 year hold. They underwrite 0% rent growth in year one. So there you go, Lonnie. 0% rent growth in year one. Then they look to average the projected rent growth from a number of data providers for the remaining projected hold period. And the max annual rent growth they'll underwrite is 3.5%. So very disciplined, very conservative rent growth expectations there. They underwrite an exit cap that's equal to today's stabilized market cap rate. Yeah, we can definitely kick that one around, Lonnie, for what we think about that. And they want to work with developers that have built at least 2,000 units, including 2 properties in the subject market, targeting MSAs with at least 1 million people. And the areas, the regions that they're targeting, really no surprise. I mean, it's the hot, call it half dozen to dozen markets that you would probably expect to be on the list. Atlanta, Dallas, Houston, Austin, Charlotte, Raleigh, Denver, Salt Lake City, Nashville, Tampa. Like, really no surprise on those major markets. But let's start with that first metric I called out there, Lonnie. Underwriting an exit cap rate that's equal to today's stabilized market cap. How do you feel about that assumption?
Well, it's interesting. We haven't really done a lot of analysis on the show about this, but if you look at multifamily cap rates over the last 3 to 4 years, they haven't really moved. I mean, this has been the one asset class that, regardless of cost of capital, stabilized cap rates have pretty much remained the same in most of these markets. And so it makes me wonder if we've kind of reached a point where it's just priced in, like that's just what the cap rates are for those assets. And, you used to be able to buy something with a going in cap rate and stabilize at something higher and grow the NOI and everyone won. And at this point, it feels like cap rates are really sticky. And so I think this is maybe a little unconventional compared to what you might have done 5 or 6 years ago in the market, but it might be something that's a new trend relative to what we've seen. If 500 basis point rate hike over 18 months hasn't shocked cap rates in some of these markets where you have significant new supply, where you have significant value add reposition assets that are midstream that the operators don't know what they're doing, and cap rates have remained this sticky, what would make you assume that in the next, call it, exit period, that you're going to see some significant change in the cap rate?
Yeah, no, I completely agree with you. Like, we've entered a different supply regime here. I mean, gosh, 3 to 5 years out, that's near term enough that I can get on board with stabilized cap rates at exit, especially when you consider the rent growth discipline they're introducing in there as well. And that interaction effect you get with rent growth and exit cap rates. I'd rather underwrite it this way than say, well, we're going to underwrite to a little bit more optimistic rent growth, but hey, we're also underwriting to an exit cap that's 20 or 50 basis points wider. I'd rather underwrite to more realistic, which is, like you said, it's a fact. Sticky cap rates and disciplined, realistic rent growth.
It's just funny how these things change over time. I mean, like, we both been in the market long enough to know, like, it wasn't that long ago that a Class A asset was, if it traded at a 6 cap in multifamily in a major market, like that was an aggressive buy on the buy side. And then, we all have documented the 3.5, 3.75 cap rates that we saw in 21 to just change the narrative on that. And so I think we're just entering, like you said, a new era here. It is interesting though, in this post and in the conversations I've had as well, we spent quite a bit of time this last year looking at the expense side of the equation for multifamily. And obviously insurance is what took the headline. It was 11+% compounded annual growth rate over the 10-year period from 2015 through 2024 was the headline number. It was like 150 or 160% raw increase over the 10-year time horizon. But you don't see a lot of people talking about expenses or expense concerns here. Like, it makes sense that they're going to say, okay, we're going to limit rent growth estimates in our DCF in year 1 or year 2. But you haven't really heard anyone talk about what they're doing on the expense side, or if expenses are even a concern at this point. I mean, if I looked at the expense growth, that was putting some significant downward pressure on NOI growth for some of these markets. And it's not just insurance, it's property taxes, it's professional services, it's your, repairs and maintenance. It's all of these things added up, adds up to some significant increased downward pressure for an operator. And, I think that's the part that, if I'm looking at 2026, I love the optimism, but what fundamentally has changed in some of these markets? I don't know, other than just people saying we're we're ready to get off the sidelines and get back in the game, which, yeah, we're all ready to get back in the game. Let's do it. But if you're underwriting 0% rent growth, you're underwriting to a stabilized cap rate, and you're not accounting really for this type of expense creep, like what's changed mathematically? And the cost of capital is effectively the same.
Yeah. Now, over a 3 to 5 year period, maybe that doesn't bite you quite as bad. But I mean, when you're talking the increases that we've seen on some of these properties, the margin compression is real and it's real painful. We'll talk about it in this week's Market Pulse, but when you look at the debt yields and how they've shifted here for like 21, 22 vintage loans, I mean, it's highlighting some margin pressure that I suspect part of that is like you're saying, Lonnie, it is driven by expense creep. It's not just all about your rent growth realization.
And quite honestly, listen, like as an industry, there needs to be more education around the totality of operations. There's misinformation in the market about renters thinking that the rent they pay goes straight to the property owner's pocket. Like this concept of expenses is somewhat foreign because all of the articles, all of the talk tracks, all of the panels, everything only talks about rent growth. They don't actually bring into the equation the expense side, which to your point and my point has really been part of the headline here is that expense creep is real. It's inflationary pressure that's realized, it's quantifiable on the expense side. And for a lot of these owners, you're spending a lot more time and effort trying to manage expenses. And rent growth is more of a function of supply and demand, but expense growth is not necessarily something that you as an individual owner really have control over. I mean, the reality is taxes are going to be set based on an assessment. You can appeal, you can go through the process, but that takes time and money. But you're hiring outside contractors and your carpet replacement, and your painting and all of those things, like you can try to negotiate if you have a certain level of scale. But if you're someone that's operating regionally with a handful of properties, you're not getting that economy of scale. The other thing that's interesting here is that we haven't really heard from folks, at least with our people on the ground there. The political conversation in multifamily has kind of abated at some level. And I wonder if it's just because people aren't comfortable talking about making investment decisions along the political lines, which I understand. But I do think the pendulum has swung some to where we've heard from people on our show and in private conversations, like obviously markets where conventional free market rental rates are allowed and are, encouraged, clearly are going to be the ones that come out as winners here in this broader ecosystem. I know there was a takeaway this week around the COPA. I don't know if it's a statute or if it's a law or what, because it's at the local level. But that was where the city council in New York was effectively saying if you wanted to sell your apartment complex, you had to take it to the Community Opportunity to Purchase Act, had to comply with that. It looks like when Mayor Adams vetoed that the council maybe doesn't have enough votes to take that back up and get it approved. So maybe that's a win in the short term for New York. But just back to my main point here, I wonder if and where the political spectrum fits into, like, say, Brandon's post. I mean, that has to be a point of consideration for these folks.
Yeah, I mean, that's when he talked about the markets. I suspect part of that is driven by that fact is just not being spelled out. I just realized in looking back at the post, there was one more stat that I failed to mention, which I'd be remiss if I did not. The construction financing needs to be 65% loan to cost or less. So a very reasonable leverage point there on the target.
I wonder, we've seen the stats in terms of new construction pipeline coming down the pike, and it's the data on the new construction starts, which is, paltry relative to what we've seen over the last several years. Wouldn't this actually be a pretty good time in some of these markets to maybe push the envelope on some of those new construction starts? I mean, it feels like, maybe you take Austin and Nashville; those are out of question. Obviously, there's not enough demand. But if I look at Salt Lake City, if I look at Dallas, I think those are markets where I'm maybe wanting to get in the construction game. I think there's still upside opportunity in some of those markets.
Oh, absolutely. I mean, for the amount of time it takes to actually get one of these out of the ground, this is the point in time where you should be planning, right? When everybody's walked back and everything is seemingly quiet and folks are on the sidelines, that's when you should be poking around the permitting office.
So our team on the ground at NMHC has been sending us their notes, their feedback. I know they've met with a lot of podcast listeners and Trepp clients, but something interesting that our colleague Dan sent us was that he's hearing a lot more about bridge to bridge lending specifically.
So, Stephen, I think we've seen this and we've been kind of on top of this since the beginning of 2025. If you look at the CRE CLO issuance in 25, we topped out the end of the year just under 31 billion. And a large portion of that was exactly what Dan's describing here, was bridge to bridge, right? So they weren't able to extinguish the initial bridge loan and go into something more permanent. They just went right back into another bridge loan. And I think you'll see a continuation of this until some of those value add reposition, lagging lease up type of properties actually start to hit pay dirt. And so, I would expect, and we've already seen in the CRE CLO market, I think it was last week or the week before, you talking, where are we, like a 4 billion or something like that through the first month of the year? And I would assume some of that is already bridge to bridge in nature.
Yeah, I mean, when you talk to some of the folks that are out there on the debt investment side, the lenders, the juice just simply is not there for core plus. You really need to go out there on optimistic, and bridge to bridge in the CRE CLO space works really, really well because of the sort of leverage you can get. So if you're doing this on balance sheet or in a debt fund, the mandates you either have from, again, your balance sheet capital provider or in your investments mandate is going to limit your leverage. So you might be limited to no leverage, 1 turn, 1.5 turns. When you go to the CRE CLO market, you can get like 3 turns of leverage, and combine that with the yields that you're going to get on a bridge to bridge deal, it starts looking really attractive.
So I wanted us to stick on the topic of multifamily and apartments. And this is actually an analysis, Stephen, that you worked on with our team over at Commercial Real Estate Direct, Arrest Manzi and team. We released some insights into what's going on with the Park Merced complex in San Francisco. So, Stephen, you and our teams at Commercial Real Estate Direct, we're doing an analysis looking into property values and cash flow at one of the largest multifamily mixed-use loans in CMBS. So walk us through what you saw and what you found about the Park Merced complex in San Francisco.
Yeah, we were, when I say we, collectively, the team over at CRE Direct did a really good job explaining how the Gordon Growth model can be used to estimate property values. And as part of doing that, they really did a nice job highlighting that even conservative estimates of cash flow growth could end up being wildly optimistic. And the Park Merced asset is a really interesting one, in part because it's been around so long in CMBS. I think it's now been securitized in every single CMBS cohort from 1.0 to 2.0 to now 3.0. So we're looking at the 3,165 unit Park Merced complex in San Francisco. NOI at this asset declined marginally in 2024, the last full year for which data are available. And this property really took it on the chin during the COVID pandemic, as tenants who no longer needed to be physically present in their office or in their office complexes, they moved to cheaper areas. And it put its $1.5 billion of senior debt in hot water since then. So right now, Park Merced is being handled by the receiver Douglas Wilson, which this asset was acquired in 2014 through a recapitalization that valued this asset at $1.5 billion. That year, the underwritten target was for $52.34 million of NOI, and the recap resulted in a 3.49% cap rate. 5 years later, when the $1.5 billion loan was originated, the property was underwritten to generate $60.47 million of NOI. That's, however, plunged by more than 24% in both 2020 and 2021. So while the property has recovered, NOI grew by an impressive 20.3% in 2023. The NOI has shrunk by an average of just about 1% annually since the 2015 recap. And if you exclude 2020 and 2021, the NOI has increased by an average 4.21% annually since 2015. So if we were to look at this asset in the Gordon Growth Model context, we'd use that estimated 4.21% annual growth rate for cash flow, a 4.03% going in cap rate, a 4.91% exit cap, which is equal to the average cap rates that was used last year by lenders underwriting loans against multifamily properties in West San Francisco, which is home to Park Merced. So that yields a $1.32 billion exit value. In contrast, the property was appraised last April at a value of $1.24 billion. So that results in a 3.29% cap rate on 2024 NOI. So while we do a little bit of shoehorning sometimes to get these theoretical or academic models to work with empirical data. This just shows that really, if you do your math carefully and properly, this Gordon growth framework can help you understand and parse yields down to their really essential components: going in cap rates, cash flow growth, and then change in values due to changes in capitalization rate over the hold period. And if you want to get even more technical, we could look at what happens with CapEx as well and do a cap rate that's based on above the line treatment of CapEx, right? I think that's maybe what we should have been doing all along for office properties, maybe why we're in some of the hot water we're in now, but I don't know, maybe that's a deeper debate for another day. What do you think, Lonnie?
I didn't know we were going to get this deep. I think it's interesting. I think people are realizing, to your point on the office sector, I mean, it's a very capital intensive asset class. And yeah, treating some of that CapEx below the line is maybe not the best method going forward. I think what we need to do, though, is we need to get you something autographed by the creators of the Gordon growth model. So I don't know if you know, the Gordon growth model was created by Myron J. Gordon and Eli Shapiro. This introduced the model in the 1956 paper called Capital Equipment Analysis, the Required Rate of Profit. Later became widely known as the Gordon-Shapiro model, and eventually simply the Gordon growth model. So if anyone has anything autographed, anything in a frame, anything we can do, put on the wall for Stephen, because I know he loves coming back to this. But I love this real world example here that just kind of shows, sometimes the academic theoretical does go nicely hand in hand with the data, and it's cool. And we've had listeners every time we mention this on the pod. We have listeners email us in and they want to know how to use the formula and they want to use it. And, so it's great to see this. And I will say, I think Park Merced has now replaced WeWork on our podcast as kind of one of the longest going talking points that we have here on the show, because since I've worked at Trepp, I think this property has had some form of special servicing or some red tape attached to it.
Oh, it's a it's a beast. I mean, just the scale of this. I mean, think about that. Over 3,000 units. I believe there's also a redevelopment plan in play. And I mean, shoot, look at where it's located, some of the red tape around it. I mean, oh my gosh. It's a city in and of itself.
I was about to say some multifamily firms, will grow over 5 or 10 years to get to 3,000 units. You could have it in one entity here.
While the market chases the next digital trend, smart investors are rediscovering opportunity in something real: cash flowing assets built for scale and durability. Spinoso Real Estate Group is the nation's leading privately held operator of enclosed shopping malls, partnering with institutional and family office investors to acquire undervalued centers and unlock alpha through data, precision leasing, and operational excellence. Spinoso Real Estate Group, investing in performance, not perception. Visit spinosoreg.com to learn more. So let's get into our deals and data segment and dig into some property type stories that we saw this week. Lonnie, you've been talking a lot about infrastructure with the debate of, is data center a category that falls into real estate or infrastructure? But we did actually see an interesting infrastructure story this week that talked about how builders of the Hudson Tunnel project that all work on the $16 billion tunnel that connects Hudson River to New York City is actually coming to a halt.
Yeah, this one's unfortunate because the amount of jobs that are going to be touched by this work stop it's significant. So apparently the project manager overseeing the construction of this $16 billion rail tunnel under the Hudson River said it would have to stop all work on the project unless the Trump administration unfreezes its funding. So the Trump administration in October paused funding for the project while it reviewed whether the Hudson Tunnel project included any DEI or diversity, equity, inclusion policies. And so really, since that federal funding was paused in October, they've had to do everything under their power to keep construction moving forward as planned. But with a $16 billion tunnel like this, you can imagine how quickly capital is going to run out or get spread too thin. So about $12 billion in funding for this project comes from federal grants, while $4 billion comes from federal loans to be repaid by New York and New Jersey and the Port Authority of New York and New Jersey. So funding for all of these sources has been frozen by the Trump administration, according to the Gateway Development Commission. So this is going to result in the immediate loss of 1,000 jobs. I mean, an extended loss would put 11,000 construction jobs at risk. This is just, oh my gosh.
You have all the downstream implications from just not completing the tunnel. I mean, obviously, there was a business case made for why this tunnel and rail extension made sense and the economic impacts, et cetera, et cetera. This is where those lines get blurred again. I mean, I know Haley gave the reference to data centers, but this just shows, and Stephen, you and I know in the classes that we teach, I mean, we spend a lot of time talking about the benefits of transit-oriented development. And, there are multiple studies that show, developments near transit lines have increased productivity over a hold period. And so, this is unfortunate. And this is one of those ones where you just shake your head. It's like, can logic not enter the equation and we just get move past the political whatever and get this project back on its rails?
Yeah, we're not talking about universities and DEI policy. We're talking about construction. There's something I'm sure I'm missing here, but let's free up some dollars and keep pushing, because this is perhaps one of the most infrastructure projects for New Jersey, New York over the next, 10, 20 years easily.
Let's move on to a few other stories. I want us to talk about office. You did mention WeWork earlier, Lonnie. And for those of you who don't know, we did have WeWork CEO John Santora on the podcast a few months ago. And it was really interesting to hear his perspective on the co-working space, the office market, and really the future of WeWork in general. We also saw a headline this week in the Wall Street Journal that the co-working market is roaring back to life. So walk us through what the article said and some of your thoughts.
I think after that podcast episode with John Santora, I came away feeling much more enthusiastic and bullish around co-working, at least from the WeWork perspective. And I think this article kind of carries that forward. U.S. co-working footprint, just for some context and stats here, has grown to about 158.3 million square feet, up from about 115 million square feet 3 years ago. So you're adding, call it 43 million square feet in a 3-year period. Unlike pre-COVID, where you just had a few big players, there's a lot of smaller independent operators that are growing rapidly and really capturing demand. And I think they're figuring out the nuances of how to make this work. So if you look, and this was in line with what we heard from the WeWork CEO, was major corporations like Pfizer, Amazon, JP Morgan Chase, they're using this flexible shared office space to support hybrid and satellite work models. So they can still have kind of a conglomerate of employees in a space, but at a much more flexible term with some of these co-working landlords versus trying to lease the space themselves. And if you look at the overall representation here, co-working represents about 2.2% of overall U.S. office inventory. And I think if you look at what we've seen over the last 3 years, you're going to see that number continue to grow. So, Stephen, I'd be interested to hear your position on this. But again, I think we have to kind of temper expectations. I don't think co-working is going to be 50% of the market, but I think co-working space could be 5 to 10% of the market, and I think could be a pretty stable part of that ecosystem.
Yeah, I absolutely agree that this should have its place in the ecosystem of commercial real estate, much like, say, single-family home rentals should exist in the rental market, right? The diversity of offerings, I think, are important for firm growth and firm location choice. What's interesting here is that, one of the changes that struck me out of this article is that we're going from, say, like mass operators like a WeWork to, seeing more like single site owners. So I'm curious to see how this evolves, because, I still love when I think back to your experience that you had trying to get WeWork space. Part of the struggle, I suspect, in this space is the software, right? It's a technology problem to some extent. So I'm curious to see what kind of innovation you get on the marketing and management of, call it, decentralized co-working space.
I think you have to look at it like this, Stephen. Let's take Austin as an example. Austin made a name for itself over the last 50 years as the live music capital of the world. Look at San Francisco. It's made its name as being, the biggest tech incubator in the world. I think for some of these co-working spaces, they're just tapping into some of that local culture. And if you're an independent operator, you can really create a space that caters to that need at a much more tailored way than what you can if you're like a national sole source operator where you're trying to expand using the same model across the US. And that's one of the beautiful things about commercial real estate. And we talk about it all the time is there's just a local, hyper-local endeavor where being an experienced operator in a particular market has value. And we even talked about this on the multifamily segment today. Developers want to be in certain markets and they want to work with people who have a track record in that market because local market dynamics make a difference. And I think for some of these smaller operators here, they're really tapping into that, whether it be tech culture or whether it be some other type of, office need, financial services, et cetera. And they're building out space that really fills that void.
Yeah. I mean, anybody who's worked in a really crummy, unamenitized office, they can appreciate the benefits that some of the space can offer the market. This offloads a lot of the burden for build out and maintenance and gives firms the flexibility they need to kind of expand on demand. So yeah, it was interesting to see some of the names that popped up on the list of the co-working bandwagon, like Pfizer, Amazon, JP Morgan, Lyft, and Anthropic.
And in the retail market this week, we saw several announcements of store closures. And this first one was interesting because we just talked about Amazon set to open its largest physical storefront yet. And now there are headlines this week that Amazon has also announced that it's set to close all Amazon Fresh and Amazon Go stores.
Yeah, I did have to chuckle a little bit when I saw this headline since we talked about Amazon just the other week. And I don't remember if I verbalized this, but I've never really been a fan of the Amazon Go stores. Like I kind of get the convenience of them, but I always avoided them because I don't know. I felt like I was going to be the person that set off an alarm or got stuck in the turnstile because something didn't work. There's something about the experience that just didn't resonate with me. And so Amazon, it sounds like, is going to be closing pretty much all of the Amazon Go stores, but maybe some of these Amazon Fresh stores are going to get converted into Whole Foods markets, as Amazon is looking to expand the Whole Foods footprint, I think, fairly aggressively. I don't remember the exact number offhand on how many Whole Foods markets Amazon is looking to develop over the next coming year or two, or maybe it's 5-year window, but I do like this pivot. As painful as it is for Amazon, I'd rather see them lean into a well-established, well-recognized brand and business footprint rather than try and recreate the wheel with something that really has never gone over well with consumers from what I've seen.
Yeah, so I think the number that you're getting to, Stephen, is about 100 new stores is what they're trying to do. Timeline TBD, but they want to expand by 100 with the Whole Foods. And I think, look, they're doubling down on the Whole Foods market. It's really, I think, a pitch to accelerate same-day delivery of groceries. And, just retiring Amazon Go and Amazon Fresh stores entirely just gives them more bandwidth to focus on the areas that they think provide upside opportunity. So, part of me is sad that, you're seeing one of these, a couple of these businesses go under, but I think it's good to see Amazon having enough conviction in some of their other strategies that they're doubling down on those strategies to try to make this work.
We talk a lot about burger chains on this podcast. I don't know if our listeners have picked up on this, but Lonnie, you're a Whataburger fan, right?
Yeah, Whataburger.
Steven, what's your burger joint of choice?
Recently it's been Freddy's.
Okay, Freddy's. We don't have either of those here in New York, but there were headlines this week in Bloomberg that Fatburger owner is the latest casual dining bankruptcy, and this may lead to store closures.
Yeah, so this is an interesting one. Fatburger owner, kind of funny. Fat Brands is what they operate under. The owner of restaurant chains Fatburger, Johnny Rockets, Twin Peaks, filed Chapter 11 bankruptcy here in Texas on Monday. Has about $1.45 billion of funded debt obligations outstanding and didn't make their interest payments due in October. So this is not net new for some people that in the know. They've kind of seen this coming. They plan to rely on cash collateral and future cash receipts to fund the initial phase of Chapter 11, with the budget only contemplating 4 weeks of runway. They have more than 2,300 eateries around the world, according to its website. So this is another one of those Chapter 11. We've seen several of these to round out 2025, and we've seen some of these kicking off 2026. I've never really been a fan of Johnny Rockets. Don't go to the Twin Peaks. So I think this is this is a noteworthy story. They'll probably consolidate, and it'll generate a lot of second generation restaurant space for lease.
Okay, so we started this podcast on the topic of multifamily. Let's close with a few multifamily transaction stories. This is a fun one. We're seeing a lot of pro athletes get into the CRE mix, and here's another story that we saw in BizNow this week. Milwaukee Bucks star player bought a Chicago apartment building, and this is actually a continuation of his CRE acquisition spree.
So, Steven, I think you're going to let me take the lead on this one, saying Giannis Antetokounmpo.
That's a good try there. I think
Listen,
you're
in the
close enough.
NBA, the announcers even just say Giannis. I mean, like at this point, he's a single name person. Giannis. We all know who Giannis is. The guy's incredible, by the way. Although he's trying to get himself traded off of the Milwaukee Bucks, and he hasn't been successful yet. So hopefully for him, he gets traded. And he's kind of been making these CRE investments, maybe in cities that he wants to go play in. So this latest deal, $21 million for Chicago apartment building. I like that the article referenced this as continuing his crossover, nice NBA pun there, into commercial real estate ownership. His family office bought a 56-unit, 4-story apartment building at 4513 North Clark Street on the north side of the city. Property is called Harmony Apartments, was completed in 2024, was brokered by Essex Realty Group, and Old National Bank backed it with an $11 million loan. This comes on the heels of his affiliates invested $69 million in acquiring a combined 186 apartment units across Wisconsin, Chicago, and Brooklyn in the past few months. So you might have seen his name in some CRE headlines over the last few months with his other transactions. So again, the affiliate paid $25.2 million to acquire 111 Clarkson Avenue and 520 Parkside Avenue, neighboring buildings with a combined 50 units in the Prospect Lefferts Garden neighborhood of Brooklyn. Giannis also scooped up 2 properties in Wisconsin in the fall in separate deals worth about $23 million combined, featuring 80 units total. So, it's interesting to see some of these, and I'm excited to see this for these really well-paid professional athletes. They should be making these types of investments. They have access to capital. They have access to the advisors. They have access to people that know, and seeing them, put some of their wealth into some of these commercial real estate deals, especially multifamily, seems like a pretty solid play for them.
Yeah, I'm excited. At some point, maybe we're going to start seeing trading cards with, the player on the front and then their property portfolio and some stats on the back.
They could take the Bob Knackel playbook. I mean, he kind of cemented that as legendary. So yeah, if you could see how many MVPs and how many championships Giannis has won, as well as his real estate portfolio, that could be pretty impressive.
And in Arizona, we saw Stockdale Capital Partners pay $109 million for Avant at Fashion Center, a 355-unit apartment property.
Yeah, so this deal's in Chandler, Arizona. The Los Angeles investment manager acquired the property at 555 South Galleria Way from an affiliate of Starlight Capital, which bought the asset in 2018 for $84 million. So the new purchase price of $109 shows a really nice gain on sale for the seller. Marcus and Millichap's institutional property advisors unit brokered the latest deal. As you mentioned, Haley, in the lead-in, an affiliate of Nuveen provided $77.6 million in a loan to facilitate the Stockdale purchase. Was built in 2016, has studio 1 and 2 bedroom units that range from 587 square feet up to almost 1,200.
So yeah, that was a decent rate of appreciation there you had on. We'll just go ahead and round it up, call it an 8-year hold. Maybe it was 7, 8. So it was maybe a little bit north of 3% annualized rate of return on that appreciation. And then the loan that Nuveen provided pegs that at just above a 71% LTV, if any of our listeners are interested.
And finally, some quick programming notes today. Lonnie, you were on a great webinar with our friends and colleagues at Eisner Amper this week. We talked all about what happened in 2025 in commercial real estate and where the markets are going. I know they had some great attendance there, and we got a lot of questions. Also, with Eisner Amper, we partnered to produce a comprehensive 2026 Outlook report that analyzed the connection between macroeconomic forces and CRE performance. So if you like this show, if you like our Market Pulse webinars, you will also enjoy this report. We dug into capital markets, insights and data, and also property type performance across industrial, office, multifamily, lodging, and retail. So if you're interested in this joint report, send an email to podcast@trepp.com and we will get you a copy. And we've been talking a lot about the NMHC conference this week. Trepp has a lot more trips planned for the next few weeks. We will also be at the MBA CREF conference in San Diego. If you're attending that event, we would love to meet with you. We know that's a very busy conference, but we're meeting with a lot of our clients, podcast listeners, and friends across the industry to share a lot of our market intelligence, share new ways that we're able to deliver our data to your systems and your teams, and really walk you through some of our insights for anyone that's involved in the commercial real estate or lending market. So if you're going to be in San Diego from February 8th to 11th, send us a note and we will connect you with our on-site team. We will also be at the SF Vegas conference. This is more of a structured finance conference where we get to meet with a lot of our colleagues in the CMBS and CLO world. This event is taking place February 22nd through 25th, obviously in Vegas. If you're going to be in Vegas those dates, we'd love to meet with you. Send us a note and we can make sure we get some time at that event. And of course, we can't end the podcast without giving a shout out for our Trepp Connect in New York City conference taking place May 6th through 7th. We secured a very fun networking reception spot that will allow all of our attendees to network, mingle, enjoy drinks and dinner, and really get to see and experience New York City for those of you that are out of town. We'll share some more details about that space and some of our speakers and agenda items in the coming weeks, but we're excited to already have so many of you signing up and submitting speaker requests. We've had a lot of our listeners reach out to us saying they or someone on their team wants to speak at the event. If we haven't gotten back to you yet, please be patient. But also, if you haven't submitted yourself or someone on your team, send us a note. We'd love to have you take part on a panel or a session or sponsor the event in some capacity. So more to come on the Trepp Connect front, but feel free to keep sending us emails. We'll get you signed up. We can get you a discount code, and we'd love to see you in New York in May. Turning to shout outs. Our friend and colleague, Susie S., who always has a lot of clients that are podcast fans, sent us a note and said, my client, Bridget M., is a listener and big fan of the Trepwire podcast. So thank you, Bridget, for letting Susie know, and thanks, Susie, for sharing that message. Aiden K. gave us a shout out and said he was recently recommended the Trepp podcast and has really enjoyed it. He's been spending more time learning about commercial real estate and said we've been a great resource to understand what's actually happening in the market. We spoke with Aiden several weeks ago and provided him with a lot of resources. So we also have daily newsletters, blog content, and we're happy to work with clients and people across the industry for any advisory or consulting work as well. So thank you, Aiden, for sharing your feedback. Jim H. was interested in signing up for our Market Pulse webinar that took place this week. Fred O. also wanted details about the webinar. And Gavin C. gave us a shout out for some of our data about NOI growth in industrial. Omar K. actually shared a YouTube video where he broke down our latest delinquency report and discussed multifamily opportunities in 2026. So that was cool. We've been featured in several YouTube videos over the years, so it was great to see this special shout out. Richard H. said great stuff on the podcast this week and was interested in sponsoring and taking part in the Trepp Connect conference. So we're excited to have you take part. And Sarah Y. also wanted to learn more about our webinars and online resources. So thank you guys for another great episode. And thanks to our listeners. We will see you next week. And with that, we'll close. Thanks to our producer, Carly Cento. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or just a comment, send an email to podcast@trepp.com and subscribe to the Trepwire podcast with your favorite provider. Thank you for listening and stay well.
All right.